that looks like is, let's say we do a $30,000 loan. Blow this up real quick. Do a $30,000 loan. And you can see here, I'll do the shaded area of your total payment for the first year. So you can see what that looks like. So at 7% interest, that's how much you would have paid for 1 year. So this is a simplified version of that. That's at 7%. So we'll do 7% here. We're also going to do, we'll do 8. So you can see this is a 5-year loan. So we'll do so this is 8%.
Yeah, his
And this is 9%.
it's the stuff that he has to take to school.
And then this is the monthly payment. And then you get to see at each interest rate what that looks like here. And the difference. I didn't do a sensitivity table, so I'll just move this over here. This is that's that one. And then I'll do this here. And this is, we'll do a 3-year loan. And then you can see the difference. Pretty big, right? Significant difference in the total amount that you would pay in that year. And so you got to ask yourself, you always got to ask yourself, do I have enough money to afford whatever this ends up being? So if I'm buying a car, you know, that's what it looks like. Let me, so this is a 5-year loan here. And this is a three-year loan. So here, your annual payment at 7% is this. This is how much you're going to pay on a loan over 12 months. That's the monthly payment. As you go up in interest, how much you pay goes up. Your monthly payment goes from $592 to $622 per month. And over the course of 12 months, that difference is almost $30. So an additional $30 a month just because you pay more in interest. 2% more. That translates into $345 per year. And that kind of goes to show you, some examples of why it makes sense, obviously, to have good credit, but also the impact of a higher interest rate on your monthly payment. And so here, if we're looking at a smaller term, so in this case, instead of a 5-year loan, we're looking at a 3-year loan, then in that case, you're paying less interest over the course of the loan, but you have to have the resources to cover that monthly payment. If you don't, then it doesn't make sense for you to try to do it. It's a stretch. Obviously, if we look at it this way, so let me show you what this looks like. So at 9%, over the course of this loan, say we go out 30 years, if we go out 3 years, you would have paid $4,343 in interest. And so we'll say $1,334 in interest, and that is on a 3-year loan. I'll move this over for a second over here. So that's the interest on a 3-year loan. Now let's see what the interest would be on a 5-year loan at that same rate. And so let's go down. We'll go here. 5 years. 7,360. But we do the math, right? So let's just look at this. On this loan, and this is what you got to consider when you're buying anything and you're using loan money. You buy a car or you buy property or anything that you're buying, your monthly payment is cheaper, but the interest that you're paying on the total loan amount is substantially more. So you're paying $3,000 more in interest over the life of the loan just because the loan is longer. So that's something to consider. Most people, obviously, we all want the lowest payment, but those are some things to consider over the life of the loan. How much interest do you want to pay? So one strategy would be, well, let's say you want to buy a new car and it's $30,000. So here's where the savings come in that we talked about, and reserving and establishing a goal. So let's say you already have your reserve funds together. You already have your rainy day funds together. We went through the budgeting process. You're good to go. So now you make the decision. Okay, I've done my budget. I've done what David mentioned. And now I have $1,000 a month that I can save toward additional goals. So what do? We say we put in a plan in place. And we say, well, we'll save $500 a month toward purchasing a new car. So that's $500 a month over the next year. And that gives us $6,000. Well, guess what? Guess what we can do with that? We can make that part of our down payment. So now we only have to pay $24,000, right? That's being proactive and identifying a goal ahead of time and saying we want to save for down payment on a car, right? That will reduce our loan. So let's go ahead and do this. So our original 30, I'll unhide this. Our original $30,000 purchase price was this, right? Right now, most people are paying MSRP. So for other reasons that are outside of the scope of this discussion. So
What
anyway,
is the MSRP?
so what?
What is the MSRP?
So that stands for manufacturer's suggested retail price. And so the dealer, they get their cars from the manufacturer. So like if you buy a Ford, for example, a Ford dealer gets the Fords from the dealer and they get the wholesale price. And then Ford says, here is the suggested retail price that we recommend you selling this car for. And so if the dealer gets it from Ford for, say, 20,000, then Ford says, based on that, we will allow you to have a markup of 10,000, but nothing more than that. And so that's how that works. It's Ford suggested retail price for the dealer when the dealers are selling the cars in the market.
Okay. Okay.
A good question. Good. Whenever you see that, that's what that is.
Yeah, I always wondered that when I was buying a car and I saw that.
Yep. So that's what that is. That's what that stands for. So in order to reduce your total interest, well, what did we just do? We said, you know what? I can't afford this big monthly payment. So I can't do a 3-year loan. But I can kind of afford this, but I don't want to pay that $7,000 in interest over the life of the loan. So what can we do? We can save up, and instead of buying the car and being subjected to our human impulses, we can have a little bit of discipline and say, you know what? Let me just save for a year. Let me adjust my budget to save $500 a month for a year. And look at what we did. We split the difference with that down payment. Now we have a finance charge of $5,888. So that's almost in line. So instead of us paying this, we saved ourselves about $2,000 in interest charges. So by just having a discipline of saving $500 a month and putting a $6,000 down payment on the car, even though we have bad credit and don't get the best interest rate, we still are able to avoid paying a crazy interest charge. And guess what? By doing so, we also reduce our monthly payment. So now, instead of paying $592, or in this case, $622, now our monthly payment is this, $498 a month. So from a debt management perspective, that's kind of how we want to look at things. And so we want to break it out and we say, okay, well, you know, my payment is this, and my income is this. And let's see, based on now what a loan is, now I just save myself some money by saving. I save myself some money by saving. If you don't remember nothing from today, think about that. Like, save yourself some money by saving. You can do it. It's you know, just think about these decisions before you make them, and then it makes it a lot easier, and then you can go from there. And that way, so this is what we did. We did I'm gonna show you 2 different ways of how to do this and why one may be more beneficial for you or not. So this is 5-year car loan, right? 9% and 6 down payment. This next one going to be the exact same thing, but instead of the 6,000 down payment, we're going to go with this original payment here. And so now you see, in this instance, you have $124 a month more in disposable income. Or we'll just say extra money, right? So in this case, you did 0 down payment. And this kind of gives you the impact just so you can see it at that. And then we'll just drag that over. And then we'll just act like, boom. Same thing here. Boom. Drag that all the way over. Now, if you look, and this is exactly what I was telling you, if you don't make a down payment, if you don't save to make a down payment, then you end up spending more in your payment. In this case, you made a $6,000 down payment. Your loan is still 5 years and you still had the 9% interest rate, but because you decided to delay your decision 1 year and save $500 a month, that actually allowed you to save on interest over the life of the loan. And so now you have every month more money in your account, all because you decided to save and make a down payment. Now you could like not make a down payment, and in that case, then you just kind of giving up money on finance charges. So you see that, just like that. That's how much even though you might have wanted to buy the car that year or that day or whatever the case may be. If you do it this way, then you can save yourself $1,000 every year over the life of the loan. So how much money is that, you might ask, right? Well, let's see. The loan is 5 years, so take this. And that's how much money we save over the life of the loan because we went with making a down payment. And so while we put in 6, we actually get back our original 6 from the down payment plus $1,473 in extra interest savings. That's why it makes sense to at least try to, if you can, save for a down payment and make a down payment on a car. Completely different scenario when it comes to auto loans. I mean, home loans. Now we're pressing up against time, so I'll try to jump in as quickly as possible on that and kind of give you an illustration on down payments for homes. It's different for homes than it is for cars. So when you buy a car, it's better to try to get that down payment in if you can. Understand how that payment fits within your current income level. If you don't have enough, then it's probably not a good idea to stretch. And I know we talked about the 2010, so let's go back to that for a second before I move on. So if this is your income, right? Somebody tell me what rule we're violating. If we're looking at the percent of income, this payment should not be more than, according to our rule, 20% of our monthly income. But guess what? That's 50% of our monthly income. So we're violating that rule. Let's look at this one. That's 37%. So it's a little bit better, right? So what we want to look for or look to do is keep ourselves from getting overextended. So we don't want to get overextended. And so this right here says that we are well overextended. We're bringing in $1,000 a month, and that's not a favorable situation. Obviously, we got bad credit, so that should tell us maybe we shouldn't be buying a car. B, even after we saved and we got 9%, so even after we saved, we got 9%. This payment is still above our. I'm sorry, I did the wrong math here. There we go. This. But yeah, you see that? Way too much. You're like way overextended. So the question you might ask would be, because I know you want to ask, well, what kind of income do we need to have? Because I know you're going to ask, right? Like, what kind of income do we need to have to buy this car? Well, let's see what kind of income we need to have to buy this car that we want. It's we want to go back and look at whatever car it is. We want to buy a $30,000 car. So what does our income need to be if we want to buy a car and we can only get 9% and we don't have enough money to make a down payment? Right? So what does that look like? So we're going to copy this over here. I'm going to go to a new sheet. And I'm going to ask myself, okay, what do I need this to be? Let me make this 10% by changing this. So you need to make $6,207 a month in order to have this monthly payment be 10% of your income, your monthly income. And your annual income is $74,000. So let's ask the question over here. What if you did save and you're like, okay, I'm gonna make a down payment? Well, we still want to stick to our rule. And we want to say our income needs to be, in order for us to stick to our rule, $4,939.60. So we need to make $59,000 a year in order to have this payment. You guys see where I'm going?
I believe so.
So that basically is the amount of income that you need to have in order to afford the car that you're trying to buy. So if you want to buy this car with a payment of $498, then your monthly income needs to be $4,939 a month. If you want to buy a car and the payment is this, then your income needs to be $6,200 a month. Let's check that with against our other rules here. And let's see what that looks like. Let's see if we're in line with our 20% rule. Is our total debt 20% of this? Well, then we have to actually go and look at some other stuff. But right now, our total debt is less than our is less than 20% of our annual income. So on a monthly basis, remember the 20 and 10. So in this case, this particular payment is 20%, 10% of the monthly income. And that's how much your annual income needs to be if you want to afford. If you want to afford a $30,000 car at 9% with a 60% down payment, then your income needs to be $60,000. If you want to buy a $30,000 car with a 9% interest rate and no down payment, then your income needs to be this. And let's see. So I'm gonna try to go through this pretty quickly, but similar. When you're looking at a home, you're looking at, let's say, 0 down payment. Let's say you get like a mortgage interest rates are like about 5.6 right now. So that is what you'd be looking at just as a principal and interest payment right there, right? And then if you obviously have to consider how that fits into your total income amount. Like if you can't afford it, then obviously, a lender is not gonna give you any money. So how do we determine that? So we have the front end and back end ratio when it comes to buying a home. And so your debt should not be more than 28% on the front end. Back end includes what we just went through with the auto loan. So if you have a home that you're looking to purchase and you already have a car note, then they're going to look at this and make sure that it's less than 36%. If you don't have any other debt, then they're going to look at this. And so let's look at your income, right? So let's say you get $75,000 a year. And so your back end, your front end is this, your back end is this. So right now, you would not be approved for a loan for a $375,000 home based on the payment and your income. Why? Because the projected debt to income is higher than your actual income. And so you, in this case, do not have enough to purchase a home. So let's look at front end and let's look at what that would look like, what home amount you could purchase based on what your income is. So let's make this 0, and then we'll go here and we'll look at what that amount could be. So the most expensive home you could buy based on an income of $75,000, this is what you probably get approved for if you were to go get a loan. So you could do $230,000 in home price if you make $75,000, and that's without you, being stretched out. Now, all this, a lender will sell you any kind of loan. They'll have you buying all types of stuff, but you know, at the end of the day, what you want to do is what is best for your own personal situation. So this kind of gives you an idea of what that looks like in terms of what you could potentially afford on a 30-year fix based on your income level. So a lender at $75,000, they'll go up to all in, they'll go up to, let's start here. So a lender would go up to, let's say, $70,000. They'll loan you, if you have decent credit, they'll loan you 237 at 4%. That's all in. This is what you need to be looking at. You know, this is what you're going to end up paying. You're going to be paying your mortgage, plus your interest, plus your taxes, homeowners insurance, HOA, all that. So this is what you're going to pay. Let's see, if you're at 5%, that's the max amount you should use if you're making a $70,000, or let's say you make $100,000. You shouldn't purchase a home that's higher than $331,000 at 5%. But guess what? A lender will lend you $400,000. Why? Because they're looking at different stuff. They're not looking at the total amount that you're going to have to pay. So they will lend you a raw mortgage, which is this, which excludes taxes, insurance, and HOA. They'll consider this, but they will be willing to lend you this. And so my thing to you is, you could borrow this, but this will have you stretched out because you're borrowing $100,000 more than what you're going to actually end up paying per month. And so those are some things to consider when you're looking at your total debt load. So let's go back and let's just assume that you decided to purchase a $30,000, a $330,000 house and your $30,000 car note. And so this is, you know, kind of bringing it all together here, where we look at our total debt. And let's say we talked about credit cards already. So let's say you have 2,000 in this one, 2,000 here. You know, hopefully you don't have too much here. Hopefully you really don't have too much here, but you know, you never know. And so we'll have this in that. And then say maybe you have a personal loan for some reason, you were trying to do some education, you're trying to do some refinancing. Let's say you have a $2,000 personal loan. You have some student loans of, let's say, $25,000. And then this is your, let's see, we'll go here and we'll add that total, the car loan. So we'll have that auto loan. So it's your 9%, $30,000 loan. And then your mortgage loan, let's say it's $300,000. And so now when you look at your total debt, that is your total debt. Now, if your home is $400,000, I know it looks like a lot of debt, but let's say we're not including assets here. So if your home value is, just to keep it in perspective, but just so you understand what the impact is, the total impact. Your net worth is still going to be plus. So you're still going to have a net worth that is going to be, you know, obviously greater than zero. But this section is not about the asset side, it's about the liability side. So even though your net worth is that, you still have to pay off the debt. Like, if you don't pay off the debt, then it provides strain on earnings later on, and also how you attack or achieve other goals. But based on your long-term debt, this is what your interest turns out to be. And so we'll have to plug that in. So this E15, 14, and that. Okay, so now when we look at our long-term borrowing rate, comes out to much less, but it's still pretty heavy. And the reason why this is low is because your mortgage is a higher percentage weight of your total debt. Now, if you didn't have a mortgage, it's going to knock that out. So now you see how your long-term interest rate jumps. So this is how you want to look at stuff when you're trying to manage your debt. This is good debt. This is bad debt. This is, I would say, indifferent. Because the benefits of student loans are education and higher earning potential. So some people believe that this is good debt here. Some people believe it's bad debt because you don't really have an asset, a hard asset to kind of hold on to at the conclusion of paying off your debt. So it just depends on your perspective. And this one could also be good or bad. You know, if you got a personal loan because you're in financial distress, that's a bad thing. But if you got a personal loan to finance higher education or refinance higher interest debt, then you know that could be a benefit. So depends on how you look at it. This all bad. There are some benefits to managing credit cards, as we talked about in earlier sessions, and using debt to float things and take advantage of rewards and cash back interest types of arrangements. But if you're not paying these off each month and you're carrying a balance, that is bad debt, because most of the time this is consumer debt, usually. It has no return on investment. And so if you are carrying a balance, it's usually not favorable to do so. And so in terms of debt management, usually knocking out the highest interest first. And so in this case, people try to attack this one. So you knock that out. And if you look, let's go. Let's look. Let's look at this short-term interest rate, right? And then let's look at our total interest rate. And then we'll see as we knock out our higher interest. So we'll put over here order of payoff. And we'll just kind of drop this over here like that. Bring that over, and then just so you can see. And that, and let's see, order of payoff. So we'll do number 1, 2, 3, 4. Obviously, it's self-explanatory that you would want to pay off your credit cards first, because they're the highest interest items. Then that, and finally, I would say, so your student loans, and then lastly, your personal loan, assuming that the interest rate is low. Now, this is good debt, and it's not one of those situations where it's like, okay, I'm going to go ahead and pay this off. One of the reasons why you don't want to pay off your mortgage fast is because that capital could be used to generate higher returns elsewhere. So if you can generate returns of greater than 4.5% in some other investment vehicle, it does not make sense to pay off your mortgage loan early. Now, if your mortgage loan, let's say we have a hyperinflation environment and your mortgage loan ends up being like 10%, then you absolutely want to try your best to pay off your loan early. But that's not the case right now. So for now, this will be NA, and we will leave it at that. This is good debt. So let's do it. Let's see what that looks like. This is our total short-term rate, and this is our total all-in interest rate right now. So we knock out this one, boom, the interest rate goes down some more. Boom, we knock that out, that goes down. Boom, look at that short-term APR going down. Boom, we knock that out. Oh, and now we don't have any short-term debt. And now we're just left with, we'll just leave it at $1. And now, so the math still works. We only have $1 left. And then boom. So the next thing we try to knock out, this is a 5-year loan, but let's say we bring it down to, let's say, I don't know, we're gonna give ourselves some cushion here. We'll say 5 years. We'll knock this out, right? So in 5 years, we're being super aggressive, and we're gonna really go after knocking out our loan. We're gonna pay it down by half, and then we're gonna try to knock out the personal loan as well, and the student loan. So now, effectively, we're just holding what would be considered long-term debt. So this is long-term, and this is an installment loan. This is 30-year term, 5-year loan. And then this is a 30-year. That's 5-year fix. We have duration here. And then this would be revolving. And then you just obviously knock out all of your revolving credit. And then this is, usually these are like, they could be anywhere 5 to 10-year fixed. And this is like 5-year fixed. So that's common from that perspective. And so there you go. And from a debt management perspective, you want to pay off your revolving rate assets first. They're usually the higher interest rate debt. And then you want to focus after that on the higher interest. So just by what we were talking about in general, your revolving rate debt is going to be higher. The cost of it is going to be higher than your fixed rate debt. So you want to take care of that first. Then take care of your most highest interest rate, fixed rate debt. Go from there. And that is managing debt appropriately. right. Any questions? No questions? All right. Well, I hope you guys have enjoyed this session on debt and debt management, both on the short-term side and the long-term side. And there'll be more strategies that we can talk about going forward in terms of how to bring it all together, and go from there. But at this point, if there are no questions, then we will conclude this session on debt. And this session is actually recorded, and so let's see, zero otherwise. Yep. Then so I will have this template available, and the video will be posted, and then people can go back if you were not able to look at it, and go from there. Walk through the model, and car note, home loan, all those good things. And if you have questions, you can always ask me, shoot me an email, and we can go from there. But debt management, and I think that's it. Thank you guys for attending. I appreciate it. And I will see you on the next one.
Okay, bye, David.